Hello everyone, welcome to the 46th episode of me learning how to trade in Forex. So in the last episode we went through how do Forex brokers work. We read through the story between Spider-Man and Batman, read through basically Batman representing us as the traders and Spider-Man represents the brokers. And we read through and made through all notes on this, slippage, negative slippage. We saw Iron Man at the end, and now we're doing, is the Forex broker a legitimate company? So yeah, let's get started. Who are you trading with? Is the Forex broker a legitimate company? Can you trust it? Unlike Batman in the story from the previous lesson, you are not going to know who you're trading with. And even if you did, that doesn't mean you should blindly trust them. Do not trust Spider-Man, he stole my money, feel free to skip his upcoming movie. Okay. Even though it started as fun and games where Batman and Spider-Man were supposed to be making friendly bets on trying to guess where GBP/USD was headed, it didn't end up so friendly. Batman ended up getting duped by a fellow superhero who was supposedly a good guy. If you're not familiar with the story above, this means you haven't read our earlier lessons on how Forex brokers kind of work, starring Batman and Spider-Man. It's highly recommended that you read this lesson first. Forex brokers. In order to trade Forex, you will need a trading account with a provider of online foreign exchange trading or CFD trading services, more commonly known as retail Forex brokers or CFD providers. When you open a trading account with this company, you will need to deposit money to the account so you can trade. Are you sure you can trust this broker? Unfortunately, not all brokers are honest and trustworthy. A big issue with the retail Forex trading industry is the lack of transparency and unclear regulatory structures with insufficient oversight. Due to its decentralized and global nature, the Forex market is less regulated than other financial markets, making it more prone to fraud. And with the rise of internet-based trading platforms since the early 2000s, Forex trading has become even more accessible and popular among retail traders across the world. This explosion of noob traders, fresh meat, creates more opportunities for dubious behavior by shady brokers like fraudulent schemes, order manipulation, refusal to pay out for wins, or preventing account holders from withdrawing their funds. In the past, many Forex brokers were unregulated, which means that these brokers were not operating under the supervision of a governing body whose role is supposed to protect traders from being fleeced. So if you're scammed, there's no hope for any legal recourse. Your money's gone. Fast forward to today, and whilst the retail Forex industry has slowly become more regulated, shady brokers still exist who should not be in business. This is why the most important first step is verifying the legitimacy of the Forex broker you choose. When you're looking to trade Forex, it's important to identify brokers who are reputable and avoid the ones that are not. You don't want to end up being part of the unfortunate group of individual traders who fall prey to a Forex scam. I got scammed. In order to identify reputable brokers from the shady ones, you need to do your homework before depositing a large amount of money with a broker. The Forex broker you choose is going to be your first critical decision as a new trader. Why? Because you're going to be handing over money to this company. So the first thing you need to make absolutely sure, especially before you make your first trade, is once you transfer your funds to the broker, if you'll also be able to withdraw these funds. You might make the assumption that once your money is in your trading account that you'll be able to trade with it and then withdraw it whenever you want to cash out your profits. But don't just assume this is true, verify. Never assume, always check. You can be the most awesome trader in the world, but if your broker disappears with your money, then it doesn't matter. So if you'll also be able to withdraw these funds. Most awesome trader who is also awesomely broke. So, slippage, before making any trades, verify the broker's legitimacy. Check you'll be able to check you can withdraw funds. You'll end up just being the most awesome broke trader in the world. Laughing face. If you want to stay awesome but avoid being broke, then here are some important questions to consider before choosing a broker. Is it a real company? Is a Forex broker a real company? Don't be fooled by a nicely designed website. Make sure there's an actual legally incorporated company behind that website. Here are things to look out for to verify that they're a real company. What is its formal business name? Where is it incorporated and registered to do business? How long has it been in business? Can you find anything on Google about the company? Have there been any recent press releases or articles about the company? Where is it located? Does the company have a physical office address? Don't be fooled by a listed address on a website. Make sure there's a real office behind that address. A simple way to check if the office is an actual office is to use Google Maps. Enter the address in Google Maps and see what happens. And to get a better view of the office, you can also use Google Earth. Enter the address in Google Earth and see what happens. Zoom in until you can see the building they're in. Is it an actual office building, or does it look suspicious? If it looks like the building above, are you sure you really want to hand over your money with this broker? If no building is present and instead you're seeing a warehouse or a tiny tropical island, or even worse, an empty plot of land, you probably want to pass on this company. Who runs the company? Do you know who runs the company, or is it a ghost corporation with no active employees? Who are the principals of the company? A principal is generally someone who holds a significant ownership stake in a company or has a formal title and ability to control the company's activities. For example, principals could be the founder or co-founders, president, CEO, COO, CFO, and other C-level officers, or any person or entity that owns 10% or more of the company. Beware of ownership opaque companies where their true owners and or company officers aren't disclosed. This lack of transparency might be due to the fact that it's actually a criminal enterprise whose members wish to remain anonymous. If you're trusting a company with your funds, you should know the people who are in control of the company. If something goes wrong, you'll know who to hold accountable. Can you contact the company? Does the company provide multiple ways to contact them? You want to make sure your broker is there when you need to ask a question or have a problem. Does it have a phone number? Does it have an email address? Does it have a live online chat? What are its customer support hours? It's not enough to see all three listed on a website. Just because it looks like there are multiple ways for you to get in touch with the broker doesn't mean it's true. Verify that they actually all work and it's not just for show. Call the phone number. Does somebody pick up quickly? Send an email. How long does it take to receive a reply? Automated replies don't count. Start an online chat. Does it work, or are you simply asked to send a message by filling out a form? If the online chat does work, are you talking to a chatbot or an actual human? What are their customer support hours? Is their support staff available 24 hours a day, 5 days a week? You can also test how good their customer support is by opening a demo account. Once you logged into their demo trading platform, send them a question using their support feature. Since you're a potential new customer who may open a live account, they should be responsive. If not, it should make you wonder how their support will be once you're already a customer. I'm sorry I annoyed you with my excellent customer service. A reputable broker should have a dedicated support team that can answer your questions. In a live trading situation, phone access or live online chat is a must, since email replies may take days. At the end of the day, you want to make sure that a broker will be there for you when you need them. Is your money safe? Do not rush into opening a live account or real money account without knowing how your funds are handled. You need to ask the following questions. What bank do you use to store customer funds? Are customer funds held separately from the company's bank account? The Forex broker should be using a reputable bank. Ask who they use. Would you trust your funds with an unknown bank? Before you deposit any funds with a Forex broker, make sure it uses segregated accounts. A segregated account is a dedicated bank account where all its customers' money is kept completely separate from the company funds. This means that your money is kept entirely separate from the broker's money. The main reason for segregated accounts is to prevent the broker from using your money, your funds, outside of your trading account. If a Forex broker does not segregate accounts, it will be able to use the customer's funds for operational expenses, and maybe an exotic sports car or two for the CEO. Thanks for the funds. Or it might just use all the deposited funds to buy a boatload of Bitcoin and disappear. In the past, shady brokers have used their customers' money for their own purposes, putting this money at unnecessary risk. You do not want your broker to use money for the wrong reasons. A segregated account protects your money against dishonest and fraudulent behavior from brokers. Should a broker become bankrupt, it also ensures that customers' funds are easily identified. In the event that the Forex brokers become insolvent, your money will not be affected. Depending on the country, regulations state that segregated accounts can't be used to pay creditors, and customers' funds must be returned to the customers. Imagine a broker's money and his customers' money all mixed together. If this was the case, companies to who your broker owes money would come after your money. Having segregated accounts ensures that customers' funds will be easily identified and returned in case of bankruptcy. Segregated accounts between customers' funds and a broker's funds provide safety. If a broker does not use segregated funds, do not deposit your money with them. Summary. In order to trade Forex, you need to use the services of a retail Forex broker, and since you'll be depositing your hard-earned money, you'll need to DYOR and do your own research and make sure the company is legit. Let's review the questions that you should consider. Questions to consider when choosing a Forex broker. Is it a real company? Where is it located? Who runs the company? Can you contact the company? Is your money handled safely? There is one last question that you should consider that's crucial. Is the Forex broker licensed and regulated? Is the Forex broker licensed and regulated? This topic is so important that it deserves its own lesson. Is the Forex broker licensed and regulated? Is the Forex broker licensed and regulated? Is the company licensed, regulated and authorized to operate as a Forex broker where you live? Notice the extra emphasis on where you live. Where you live. It's not enough to verify broker's regulatory status. You need to know which regulatory agency it is registered with and whether the jurisdiction that the regulatory agency oversees covers the country where you live. Forex market regulation refers to the rules and laws that firms operating in the Forex industry must follow. The purpose of regulation is to protect you from undisclosed financial risk, abusive practices like price and order manipulation, and fraud. In other words, regulation tries to protect you from shady brokers doing shady things. There is no single global body governing the Forex market to police the massive 24/5 markets. Instead, the responsibility mostly falls on a country-by-country basis. Most countries have a regulatory authority that lays down a framework of rules and standards that must be followed by retail Forex brokers. These rules include being registered and licensed with the regulatory body, and undergoing regular audits and reviews to ensure that companies comply with regulatory requirements. Each Forex regulatory body operates within its own jurisdiction and regulation, and enforcement varies significantly from country to country. In short, regulatory requirements are established where all Forex brokers under their jurisdiction must comply with. If a Forex broker doesn't comply, the regulatory body has the power to issue fines and disciplinary action. These fines can be substantial and provide a strong incentive for companies to operate within the law. And if the fines don't work, the regulatory body can ultimately revoke that company's operating license should their regulatory violations be particularly severe, or if the company doesn't satisfactorily implement changes to prevent future violations. If this happens, the Forex broker can't do business in this jurisdiction anymore, since it will be operating illegally without a license. Forex regulations differ from country to country. This means that not all regulatory agencies follow the same kind of regulations or offers the same type of financial protection. For each regulatory agency, they have its own specific regulatory requirements and area of jurisdiction. Not only do the regulatory requirements differ, but the enforcement of these regulatory requirements also differs from country to country. You can create all the rules you want, but if you're not going to enforce them, then the regulatory agency is basically a paper tiger. A paper tiger is a term that refers to something or someone that claims or appears to be outwardly powerful or threatening, but is actually inwardly weak or ineffectual. Aside from paper tigers, not all regulatory agencies are credible. Some of the regulatory agencies in so-called offshore jurisdictions are essentially nothing more than the rubber stamping offices. Regarding jurisdictions, there are different levels of strictness. For example, the US and Japan are considered to have the most stringent regulatory agencies. The US and Japan are considered to have the most stringent regulatory agencies. Essentially, the stricter the jurisdiction, the more protections that individual traders have, but the most costly it is for the broker to operate in that jurisdiction. This is due to the stricter requirements such as having a local physical office and staff, requiring a large amount of money up front just to even start the business, plus additional money is set aside to avoid going bust and be able to pay out when their customers win, regularly submitting reports to verify compliance with all license requirements. Not only is there usually a huge upfront cost, but licensing costs also have to be maintained annually. Even with all the added compliance costs and headaches, reputable brokers will still choose to register and be regulated in stricter jurisdictions since it improves their credibility and builds trust with their customers. Let's be clear though, a broker that is regulated doesn't automatically mean you can blindly trust it. Strict Forex jurisdictions. Here's a map showing jurisdictions that are supervised by regulatory agencies that are generally considered strict. So we got United States, Regulatory Agency, Commodity Futures Trading Commissions, and National Futures Trading Association. Japan, Financial Services Agency. United Kingdom, Financial Conduct Authority. Canada, Investment Industry Regulatory Organisation of Canada. EU, Cyprus Securities and Exchange Commissions. EU, Malta Financial Services Authority. Singapore, Monetary Authority of Singapore. Hong Kong, Securities and Futures Commission. Australia, Australian Securities and Investment Commissions. New Zealand, Financial Markets Authority. Most Forex brokers regulated in strict jurisdictions are less prone to scams. Questionable Forex jurisdictions. Here's a map showing jurisdictions that are questionable with regard to adequate customer protection. Either the jurisdiction is lightly supervised by a regulatory agency with minimal requirements, red, or has no supervision at all, black, and allows brokers to self-regulate themselves. Belize International Financial Services Commission. The British Virgin Islands, BVI Financial Services Commissions. Cayman Islands Monetary Authority. Cook Islands, Marshall Islands. Kenya Capital Markets Authority. Mauritius Financial Services Commission. South Africa Financial Sector Conduct Authority. St. Kitts and Nevis. Seychelles Financial Services Authority. St. Vincent and Grenadines Financial Services Authority. Vanuatu Financial Services Commission. So around the equator bit basically. On the map you notice a lot of small tropical islands that are more well known as expensive tourist destinations with their fancy beach resorts. These islands are known as offshore jurisdictions, which are low or no tax countries with corporate laws that maximize financial privacy and minimize regulatory interference for both individuals and corporations. Why do Forex brokers like to go offshore? Fast and cheap to start business, minimal capital requirements, minimal or no taxes, no need to report activities to the authorities, no need for local physical office and staff. Forex brokers like to set up shop in these offshore jurisdictions to get around what they may consider overly strict regulations and high compliance costs in their own countries. Basically, the cost and difficulty of setting up a company and operating as a Forex broker are much lower. Be wary of unlicensed Forex brokers. If you Google Forex broker, you'll probably come across many companies that operate as a Forex broker without a license. An argument that unlicensed Forex brokers make is that instead of having to spend a lot of money and time to obtain a license and comply with all the rules and requirements, operating without a license allows them to drastically reduce the operating expenses and leave them with more available funds to spend on actual business, such as on marketing and promotion to acquire new customers. I don't know about you, but it's hard to trust a Forex broker that started up with $1,000 worth of capital, has no license, has no physical office or staff, and is strictly an online operation. An unlicensed company is not regulated by any regulatory agency. This means that it is not bound to abide by consumer protection rules such as safeguarding customer funds, providing clear information and disclosure of how it executes trades, and resolving customer issues and complaints. They may promise better trading conditions, including deposit bonuses, tight spreads, and ridiculously high leverage. However, we recommend avoiding them since the probability that these companies are scams is high. If you experience unfair treatment, such as manipulation of trades that result in losses or the inability to withdraw your funds, you will not be protected by any specific law or regulation. You will be on your own. Due to the company not being regulated, you won't have access to complaints and procedures or compensation schemes if something goes wrong. There will be no regulatory agency to turn to resolve disputes fairly and impartially and have the power to put things right. Why should you pick a regulated Forex broker? A regulated Forex broker means that it must comply with standards set by the regulatory agency, which helps ensure that the way Forex broker conducts business with you is ethical and fair. For example, in the US, a legit Forex broker must be registered as a retail foreign exchange dealer. If you're not satisfied with the level of service, or if you think you're getting scammed by a broker, you can report a regulated broker to its regulatory agency. While the regulatory agency usually does not get directly involved in any conflict between a company and its customer, it will investigate any instances of fraud or consumer abuse. If found guilty, the regulatory agency can issue big fines, revoke their license, and even permanently ban the broker from operating in the country. By requiring Forex brokers to operate within a set of rules as defined by the Forex regulatory agencies, retail traders can have some confidence that when trading with the Forex broker, they are treated in a fair and ethical manner. Lastly, why wouldn't you trade a regulated Forex broker? Why would you choose a broker who deliberately avoids being under a strict regulatory agency? We're not saying that every unregulated broker wants to cheat you out of your money, but given that the retail Forex industry has a history of being prone to fraud, why take the chance? True. How to verify a broker's regulatory status. Every Forex broker who is licensed and authorized to operate by their regulatory agency receives a unique ID number. So, every Forex broker who and authorized by their regulatory agency receives a unique ID number. Regulated brokers are required to display their regulatory information prominently on the website, so you should be able to easily spot their ID number, usually at the bottom of every page. A broker may claim to be based out of a specific jurisdiction, but is actually lying. The company could be falsely claiming another company's ID number, or worse, totally make up a fake ID number. This is why it's important to make sure to verify this ID number on the official regulatory agency's website. Make sure to verify this on the official regulatory agency's website. To help traders like you verify the regulatory status of a Forex broker, most regulatory agencies maintain an online database that you can access in order to verify whether a broker is truly regulated by the specific agency. A regulatory agency's website should provide information about a broker, its owners and company executives, a brief history of its operations, and any regulatory actions that were taken against the broker due to non-compliance issues or customer complaints. For example, a Forex broker may claim to be licensed to operate in the UK by displaying an FCA register number. Rather than just blindly believe it though, you should visit the FCA's website and verify their FCA license yourself. Verification can be done by performing a quick search on the FCA's website. You can search by name or by number and check if the regulatory information on the broker's website matches. If the broker is listed, make sure to verify the contact details listed are what's listed on the company's website. There are scam brokers. Alright, okay, so on the website, if it is listed, make sure to verify the contact details listed are what's listed on the company's website. There are scam brokers who pretend to be the listed company. This is why it's important to use the contact details that are registered to confirm you're dealing with the actual company before you're doing business with them. If you're unsure about a company broker's regulatory status, contact the broker directly and inquire about their current regulatory status. If you don't get an answer, that's a red flag. Trade with a broker that has a physical office in your country. If you want your money to be safe, trade with a regulated broker that physically operates in the country you live in. Using Forex brokers who operate outside of your country and in foreign jurisdictions are not always legally required to maintain license with regulatory bodies, especially in offshore jurisdictions where governance is weak or doesn't exist. If the regulatory agency, the broker and you are all in the same jurisdiction, you will be better protected because you can report your broker to the regulatory agency if you feel you're being cheated. If the broker doesn't have a physical office in your country and or isn't regulated in your country, you're most likely going to find no legal recourse if something goes wrong. Be careful of regulatory arbitrage. This refers to Forex brokers attempting to benefit from differences in regulation between jurisdictions. For example, a Forex broker operating in a strict jurisdiction may establish a separate company, subsidiary under the same brand in an offshore jurisdiction that it perceives as more lenient regulatory requirements. The broker then directs its customers to transact through that subsidiary. For example, the broker may flaunt an EU or UK license to ensure it's safe, but then open your account with the offshore subsidiary. If you open an account with a broker, make sure the account is opened under the jurisdiction that you specify. Don't let the broker choose for you, or you might be giving up your regulatory protection. Test drive your broker. So you're interested in a Forex broker and before opening an account you've done your research. The broker looks safe to open a live account. You probably have an amount in mind that you want to deposit. Don't do it just yet. Take the broker for a test drive first. Make a small deposit. Open and close a couple of small trades. Request to withdraw your entire account balance. Confirm that you received the funds. This allows you to test how easy the process is to get money in and out of a broker. How long did it take to process the withdrawal? It shouldn't take more than 24 to 48 hours, so 1 to 2 days. If it takes so long that you actually have to follow up and bug the broker about your withdrawal request, beware. If everything goes well though, and you're pleased with the test drive experience, you can then deposit a larger amount. By the way, if you start receiving phone calls from the broker trying to encourage you to deposit additional funds into your trading account, either before or after you request your withdrawal, that's not a good sign. It's fine if the broker is reaching out to see if you need help using their trading platform, but you should wonder why they're already trying to get you to add more money and trade more. What are you actually trading Forex? As a retail Forex trader, what are you actually trading? New Forex traders might be puzzled and about how it's possible to trade currencies they don't physically own. They're also often confused about how it's possible to sell something before buying it. Let's revisit a part of the earlier story about Batman and Spider-Man. Oh really, let's make a bet then. What kind of bet? How will it work? If GBP/USD goes up, I'll pay you the difference between its price right now, whatever the price is when you decide to close the bet. But if GBP/USD goes down, you'll pay me the difference. Payouts will be in cash. Also, you can choose the bet whenever you want. What do you say? Let's do it. I'll take that bet. The conversation above should give you a hint. If you're not familiar with the story above, it means you haven't read our earlier lessons on how Forex brokers kind of work, starring Batman and Spider-Man. It's highly recommended that you read this lesson first. When you buy Euro USD, are euros actually transferred into your trading account? Or when you sell GBP USD, how is this possible if you don't have any British pounds in your possession? You might think you're buying and selling actual currencies, but you're not. You are not buying or selling anything tangible, you're simply speculating on the currency exchange rates. Speculation can be described as taking the view or the directional movement of a currency's pair exchange rate. Is GBP USD going up or down? As a speculator, you are essentially making bets. An exchange rate represents the relative price of two currencies. Retail forex trading isn't about buying or selling currencies, it's about betting on a change in the exchange rate between two currencies, whether it will rise or fall. It's about betting, right? Retail isn't about buying or selling currencies. It's about betting on a change in the exchange rate between two currencies. Whether it will rise or fall. Making a bet. For example, the Euro USD exchange rate implies that the relative price of the euro in terms of US dollars. If the Euro USD exchange rate is 1.1050, it means that you need 1.1050 dollars to buy 1 euro. The exchange rate determines how many units of currency are needed to buy 1 unit of another currency. So if we put all this together, trading Forex or FX as a retail trader is just betting on the future exchange rate of one currency against another. Betting that the euro gets stronger relative to the US dollar means that you have gone long euro versus the US dollar or bought EUR/USD. Betting that euro will get weaker relative to the US dollar means you have gone short euro versus the US dollar or sold EUR/USD. Now that we understand we're just betting on whether exchange rates will go up or down, what exactly do these exchange rates come from? Where do exchange rates come from? The exchange rate comes from the spot FX market, also known as just spot FX. In the spot FX market, spot trades, also known as spot transactions, occur between institutional traders known as FX dealers. What is being traded exactly in the spot FX market? Contracts, specifically foreign exchange spot FX or foreign exchange spot contracts. FX spot contracts stipulate an actual physical exchange of the underlying currencies at a specific exchange rate. So there's an actual. It's important to point out that you are not trading the underlying currencies themselves, but a contract involving the physical exchange of the underlying currencies. In the spot FX market, an FX dealer buys or sells a contract to physically exchange one currency for another currency. This means that a spot trade is a binding obligation to buy or sell a certain amount of foreign currency at an agreed upon price or exchange rate. So if you were to buy Euro USD on the spot FX market, you are trading a contract that specifies that you will receive a specific amount of euros in exchange for US dollars at an agreed upon price. This agreed upon price is known as a spot rate. This price is determined at the point of trade, and the physical exchange of the currency pair takes place right at the point of trade or on the spot, although in reality most transactions usually take 2 days to settle. The spot rate, also referred to as the spot price, is the current market price exchange rate of a currency pair. The tricky thing to be aware of is that there is no single market price for a currency pair. That's because the FX market is decentralized. Think of the spot FX market like going to a bazaar. Let's say you want to buy a rug and there are 10 different merchants selling this rug. You visit each merchant at their booths and ask what the selling price for the rug is. Each will quote you its own spot price independent of each other, assuming they don't overhear your conversation with other merchants. After you've asked around, you'll pick the rug merchant who gave you the best price. This is your spot price for the rug. FX dealers may quote different spot rates to different market participants. The spot price is found by asking a bunch of different FX dealers at the same time, so the spot rate is really a matter of how many people you ask. It is from these spot rates that your Forex broker hopefully uses the reference when it displays its prices on its trading platform for you to trade on. We say hopefully because as a retail Forex trader, it's important to know that you are not trading in the spot FX markets. A spot trade involves physical settlement, meaning if you bought Euro USD, you would have to fulfill the contract and physically deliver US dollars and accept delivery of euros. This would be great if you are a European manufacturer who exports goods to the US, or maybe a wealthy American tourist who is about to go on holiday in Europe for the summer, but we assume you're neither. The concept of spot FX trading is similar to that of futures trading, in which the trader is buying and selling agreements to make or take delivery of an underlying asset at a specific time in the future. But the time frames are much different, whereas spot FX is delivered within a few days, futures are delivered months later. As retail Forex traders, we're not interested in actually taking possession of actual foreign currencies. All we care about is what happens to the exchange rate of Euro USD. Remember, we are simply making bets on and trying to profit from the movement of exchange rates of currency pairs. So the exchange rate price you want to make bets on trade is assumed to be based on the spot rates made from spot trades in the spot FX market. But as a retail Forex trader, you are not trading in the spot FX market yourself. If you're not making spot trades, what exactly are you trading then? Numbers on a screen. You are literally making bets on whether the numbers on the screen will go up or down. Here's a helpful analogy. Let's pretend there's a website where you can buy or sell an iPhone. On this website, the price of the iPhone is constantly changes based on how many people are buying the iPhone versus how many people are selling their iPhone. Technically speaking, if the current iPhone price is 1,000, you should write it as 1,000 iPhone over per USD is 1,000. One iPhone can be exchanged for $1,000. The same thing if the iPhone was priced in euros. If the current iPhone price is 900 euros, you could write it in iPhone per euro is 900. One iPhone can be exchanged for 900 euros. In this example, we'll assume the iPhone is priced in US dollars. You're glued to your computer monitors, you watch the price move up and down. You're a devout Android smartphone user and even have a huge green tattoo on the Android logo on your chest, so whilst you personally hate iPhones, you think the price of the iPhone will continue to rise due to a strong demand from irrational Apple fanboys and want to try to make some money on this prediction. But you don't want to deal with having to physically buy an iPhone and then wait for the price to rise and then having to physically sell it for profits. You don't want to own the iPhone. That would mean having to touch one. The mere thought makes you nauseous. You just want to make a bet that the price will go up from here. Now imagine there is a totally separate website where all it does is monitor the price changes of the iPhone from the first website. Think of this website like a scoreboard that simply displays what's going on the other website and updates in real time. But it doesn't just display the current iPhone price, it also allows you to make bets on whether the price was shown will go up or down. Here's how the bet works. You and the company website agree to pay each other changing the iPhone's price. Depending on which way the price moves, one party pays the other in the difference between the time the bet was made to when the bet was closed. If the difference is positive, you win the bet and the website pays you. If the difference is negative, you lose the bet and you pay the website. For example, you see that the current price is $900. You think the price will go up from here, so you place a bet. In order for the website to accept your bet, it asks you for a security deposit of $100. This deposit is needed just in case you are wrong and the price starts falling. So this is the margin, isn't it? People who lose bets tend to ghost you and disappear rather than paying up. The website wants to protect itself from this risk of dealing with deadbeats. If the iPhone's price falls to $800, your bet will automatically be closed and the website will keep the $100 to cover your loss. But if you win, you get the deposit back. Fortunately, the price proceeds to rise to $1,100 and you decide to close your bets. The website pays you $200, the difference between the price when you open the bet and when you close the bet. Your security deposit is also returned. As you can see, when you make a bet on the second website, you're not actually participating on the first website, whereas where the actual buying and selling of the physical iPhones is happening. You are simply speculating on the price direction like a betting game. You never actually bought or sold an actual iPhone. Now substitute the scoreboard showing prices of iPhone USD over UR USD, and now you have a good idea of how retail Forex trading works. You're trading a scoreboard of FX rates that your Forex broker displays to you on its trading platform. For example, if you think Euro USD will go up, you click buy. If you think that Euro USD will go up, you click buy. When you buy, you're placing a bet with your Forex broker that the price will go up from the current price. You don't actually own or take possession of the currencies. It's not like trading stocks, whereas when you buy an Apple, you actually own Apple shares. When you buy Apple, you actually own Apple shares. When you buy or sell Euro USD, you're not actually buying physical euros or selling physical dollars. What you're actually doing is making a directional bet on the exchange rate or price itself. This is done through the use of a financial instrument known as financial derivative contract. Derivative. A derivative is a financial instrument that enables traders to speculate on the price movement, changing price of assets without purchasing the assets themselves. This is done through the use of financial instrument known as a financial derivative contract. A derivative is a financial instrument that enables traders to speculate on the price movement of assets without purchasing the assets themselves. The value of a derivative is dependent upon or derived from the value of its underlying assets, which can include bonds, stocks, commodities, crypto, or currencies. In this specific example, the underlying asset is Euro USD. Because there is nothing physically being traded when derivative positions are opened, they exist as a contract between two parties. So when you buy Euro USD, your Forex broker creates or issues a derivatives contract between itself and you. This contract is known as a contract for differences, or CFD. So themselves nothing is physically traded. They exist as a contract between the two parties, between you and the Forex broker. So when you purchase a currency pair, your Forex broker creates a derivatives contract between them and yourself. This contract is known as a contract for differences, also known as CFD. Cool. That explains a lot actually, because I think right at the beginning when we first started doing this there was mentions of CFDs and spot FX, trading quote currency for the base. CFDs trading contract and mirror traded contract. Spot FX is trading quote currency for the base. CFDs trade a contract that mirrors the price of a pair. Yeah, they weren't really explained that well, but this one explains it pretty well, so very good. But yeah, I'm going to leave this episode here. Thank you guys for watching. In the next video we're going to cover trading Forex with contract for differences. So I will see you guys in the next. See you then. Bye bye.